Hi, everyone. We are very happy to welcome you here in Business Club Africa. We are enjoying together a series of conferences around this question, strengthening Africa's economic resilience today. And our panel today will focus more specifically on how to keep financing companies and industries across the continent in this very difficult period. According to the African Development Bank, the economic outlook growth for the upcoming years were pretty bright. The growth rates expected were of 3.9% for this year and of 4.1% for next year. But with this crisis today, due to COVID-19, the whole picture is changing and is challenging the companies in all the countries across the continent. Knowing that access to funding is very essential to keep companies growing, and also knowing that financial risks have constantly grown these last months, how can African companies keep raising money today? That will be our main question. And to answer it with us, we have the pleasure to have Ladé Araba. Hi, Ladé. You are a seasoned development finance professional with over 17 years of experience, and you previously served as technical advisor of the former Minister of Finance in Nigeria. Hi, Ladé.
Hi, Hanane. It's a pleasure to be here. Thank you.
We have from Mauritius, Guido Boysen. Hi, Guido. You are co-lead of Vital Impact Relief Facility with 25 years experience in the financial services and consultancy industry. Hi, Guido. Thanks to be with us.
Yeah, pleasure. Thanks for inviting me.
Yes, Tito Cookey-Gam. You have been investing and consulting for technology startups on the African continent. Hi, Tito.
Hi, Anna. Nice to be here with you guys.
Thanks. And finally, also with us, Angela Homsi. You are international tech investor and sustainability expert. You are currently focusing on sustainable investments and businesses in emerging economies. Hi, Angela.
Hi, everyone. Delighted to be here today.
I will start with a first question that make us discover most what you are exactly doing in Africa today. It's a question that will set the scene. We know that in time of uncertainties, innovation is much more critical than ever. More and more businesses across the continent are trying to adapt themselves. Tito, I will start with you. As an analyst in charge of investments and operations, you are investing a lot in tech companies in sub-Saharan Africa. Do you see in this period of crisis a greater opportunity in tech and digital solutions in Africa?
I mean, so how we see it is, we're not sure if it's greater per se, but I think people will be building less fragile companies. I think there'll be a lot less hand waving and people will get back to basics. So in a sense, I think the African consumer is either, what's built in Africa is either what we need or what we don't know we need yet. It's not really what we want, because I think we import a lot of the applications and tech that we want. And then it's mostly what we need that is built here. And you're going to find, less fragile companies being built. I think sector-wise, there being, education and healthcare have been neglected on the continent in general. So we think there's going to be a lot of progress in edutech and healthcare and how people think about that. And then there's going to be tech brought in to, because you're skipping several steps, you're going to need tech to improve efficiencies. So we think that's going to be important in those sectors. I think with logistics and mobility as well, just because the average commute for an African is a petri dish for germs, an average commute in most places actually. So I think mobility and logistics will have a lot of innovation. There's already a lot of innovation on the continent. So I think mobility and logistics, mostly supply chain and moving people around, so goods and people around, will have some innovation there. I think something to keep a close eye on is also agri-tech, so agriculture. There's already a food shortage on the continent and globally. And I think at some point tech needs to meet the harvest. So I think there should be, a lot of innovation in agri-tech as well, just due to, supply chain imbalances because of COVID.
Okay, and do you already identify which kind of technology or IT services that you would be more interested to invest in?
So I think nothing really changes for us. Our thesis remains the same. So we aren't going to be specific because of COVID, but I think definitely education, healthcare, logistics, and agriculture will receive some more attention. But I think the overall thesis remains the same for the firm and for us.
Guido, as I said before, you are the co-lead of a newly launched COVID emergency debt facility. Almost the same question. How do you target today the companies who could benefit from your loans? Are there any changes in the profile of these companies due to the current crisis?
Vital Capital has been investing in Africa for a while, since 2011. Usually investing in companies or building companies really from the ground up. And so they've been quite successful in doing so. Some of our portfolio companies are now in need of liquidity. So we asked ourselves, what can we do? How should we respond? How can we help fundamentally good companies in relevant impact sectors? How can we help them weather this storm? So we created a $10 million facility for companies that are fundamentally very strong, deliver essential goods and services to local low-income and middle-income communities in Africa. And so this facility provides liquidity essentially through loans. So we provide loans from $800,000 to $1.2 million to these companies. So it's quite different from what Vital Capital has been doing so far, but we feel that this product is in need in particular. Not all the banks might be able to provide liquidity to companies that are struggling. They probably have lots of demands. Their requirements tend to be quite strict. And so we feel that this facility is a good addition to what the traditional financial sector offers to those companies.
Could you please, Guido, give us the details on the payback structure and on how companies who really are in need of cash today apply for your loans?
Yeah, so the facility is up and running because it's capital that was provided by Vital itself. So people can apply through the website, vitalcapital.com. People can fill in an application form and then we can screen it. We are set up that we can respond within 7 days to see whether something fits. And then we go into a detailed due diligence. The idea is to get monies to companies within 45 days, ideally even faster. Because again, we understand that time is of the essence. We also work through our local networks. We focus on a number of countries, starting Kenya and Uganda, and then in the second phase in Ghana, Ivory Coast, Senegal, DRC, Angola. And so in those countries, we have our own networks with other funds, other investment funds, with the banks, with accountants, consultants. So the SME ecosystem we work with, and that's the way we reach out to companies. As I mentioned earlier, companies can apply through the website and we'll respond very quickly.
Thanks, Guido. Ladé, you are a managing director of Africa of Convergence, and as you guys focus on blended finance, could you please tell us more about what blended finance is and how it can concretely support sustainable impact investment in Africa?
Absolutely. Thank you so much, Hanane. And again, it's a pleasure to be here. Thank you for inviting me. So Convergence is the global network for blended finance, which is really all about financial structuring. So the way that we define it is the application of concessional capital, whether it's from public sources like donor agencies, the multilateral development banks, the development finance institutions, or even from philanthropic sources like foundations, utilizing that concessional capital to de-risk transactions in order to improve the risk-return profile and basically create things that a traditional investor is willing to place capital into. So within blended deals, we're looking at a positive financial, risk-adjusted financial return that is commensurate with what you might be able to obtain in a developed market or where there is a risk premium for taking on additional risks. There is leverage. So typically we see that for every dollar of concessional capital, $3 to $4 will come in from the private sector. And then thirdly, with us, blended finance is really targeting transactions that will ultimately drive the sustainable development goals. So in some way, they're contributing to socioeconomic development as well as environmental sustainability. Now, when you think about this unprecedented pandemic that has overtaken the world and effectively is destroying a number of companies, destroying assets and value, you do see the importance of blended finance. We think that this is really the time for these companies to go back to the drawing board. So the two important criteria that you would typically factor into when deciding to start a business is one, do you have a viable business model? Is there an addressable market? Do you have a value proposition that basically makes sense for this market? And then secondly, what capital structure would ensure the success of this business? So if we go back to the drawing board, we think as a starting point, perhaps the business model does have to change. Maybe you do need to pivot. Maybe you do need to think about other ways in which you incorporate technology. If you have not really mainstreamed gender, not just as a box that you tick, but actually thinking about ways in which addressing gender might strengthen your revenues or create new revenue streams that previously didn't exist. I think that's sort of the starting point. The second area would then be your capital structure. This is probably not the time to be looking for expensive debt, especially if you are cash flow negative and are basically needing to apply for emergency liquidity from a number of facilities, including the one that Guido has mentioned, thinking about accessing grants. What we have seen in the last couple of months is that a number of donor agencies and the DFIs and even foundations have actually set up these types of structures to provide emergency liquidity, but they're doing it on concessional terms because they understand that a number of SMEs in the region are really struggling and they may not survive the pandemic. So the objective now is to make sure that these companies do not become insolvent, you don't lose the jobs, so they're willing to inject grants to help them access working capital and basically be able to service other obligations that they have. Other things to think about would be concessional debt. So if you are going to borrow at this time, make sure that it is not expensive debt, because you don't want a situation where you come out of the pandemic and your company is highly geared and effectively you're not able to survive post the pandemic. It's certainly also a good time to think about equity and quasi-equity type investments. These can also be structured through blended finance, where you might get equity that is not, in the traditional sense, but where, some other type of investor is willing to give you more favorable terms and basically give you a bit more flexibility, where the return expectations maybe are not as aggressive. So thinking about ways in which you can access cheaper capital becomes very important. And I also think that companies can take advantage of things like technical assistance, which can also be utilized. I think oftentimes people think technical assistance just applies to capacity building, but actually you can apply technical assistance to address other market failures or other risk sources that can potentially undermine the company's revenues or ultimate success. So think about, technical assistance facilities that are available and whether or not, you may want to tap into them. And the last thing that I'll say is, even as you're thinking about, blended finance or approaching concessional capital providers, remember that they're ultimately looking for socioeconomic and environmental impact. So you as a business, when you're approaching them, you need to think about how you can demonstrate this impact. Just as if you're approaching an investor, you've got your track record, you've got your financial model, you've got your financial statements. You also need to be able to document and quantify the type of impact that this concessional investment might be able to produce for the concessional capital provider.
Thanks a lot, Ladé. And I will come back in another question later on how to create sustainable impact, actually. But first, I would like to ask Angela. We didn't hear her yet. Angela, as a sustainable impact entrepreneur investor focusing on using technology and innovation to solve unmet needs in Africa, how do you make sure that the companies you have invested in are really getting good results? And how do you measure those sustainable impacts?
Sure. Thank you so much, Hanane. So we're lucky that even before the coronavirus crisis, our business philosophy and our investment philosophy, both as a business owner and as an investor and minority investors in companies, our core philosophy was to only look at business that are solving real needs. Business that are solving really bottom of the mark of pyramid necessities, things that people in Africa and mostly lower income and lower middle income people in Africa just cannot live a decent life without. And unfortunately, there's a lot of those needs in Africa that are not met until today. And that there's a lot of work to do on that. And technology today has proven that they can provide a very affordable, inclusive, cleaner, greener solution to those unmet needs that the old school infrastructure has failed to provide for however long we can look at. So all our businesses have been focused on these real needs. And what happened with the crisis now, with the COVID crisis, is those needs are the ones that are not going anywhere. They're not going away. They're actually more amplified. People do not care anymore about this discretionary spend. They do not care anymore about the nice to have. Everybody is focusing on, the basic stuff. Like you need to have, clean, clean eating, good eating. You need to have medical care. You need to have the ability to have clean, basic access to energy and cooking and agri-tech products. And that's the stuff that we looked at. Agri-tech, clean tech, med tech. Those are the areas that we work on. And we work, as I say, at the bottom of the pyramid, which means that even before the crisis, we were in a model where everything has to be deeply affordable, based really on very lean business models. And something that has to be based on volume rather than on large margins type of business model. So our business, if anything, are actually doing extremely well in terms of the needs from the ground. They need to actually double up on their efforts. Now it's a bit complex because of the restrictions on the additional costs that you have to put in place in terms of making sure that you provide everything you need safely for your staff, safely for your clients, safely for your operations. So the business is more complex and it has to adjust to the new reality, but the demand is very strong. And among the businesses, I would say there's three types of businesses that we see. There's the ones that are being named like essential provider, essential businesses. And those that just have to hit the ground running and do whatever they can to double up on their effort and be there in the field, adjust their operations to make them safe, but they have to keep going and they have to go. And the second part of the businesses is the second category, I would say, which are businesses that have a technology or an angle that they can leverage and pivot a little bit in order to provide a smart solution to what's going on. So we're seeing this pivoting going on to serve the needs of the crisis. And I think those pivoting and adjustments are important for the time of the crisis, but they're probably as well very interesting for the hopefully post-crisis times. So they're learning new processes and learning new things that they can do. And then the third part, which gratefully we're not so much exposed to because of what I say previously, that we're focused really on real needs, businesses, and unfortunately are not priority businesses in those days. I mean, things that are just nice to have, not essential. and they're important for the economy because it creates jobs because of a lot of other reasons. But then in the current really acute phase of the crisis, all I think what they need to do is to just adjust by as much as possible, lowering their cost base, becoming as flexible as possible in the way they do their operation, their SG&A, and their cost base. And hopefully it's valid for all of them, but for those that needs to retain jobs while they don't have economic activity, get access to these relief fundings that institutions are putting forward. And I think what Ladé said is extremely important in these days. I'm a big believer that blended finance role is just that, is to be there in time of crisis, to be able to provide a safety net so that private investors can, despite the risk reward being at a different, the risk level being at a different level, are still able to deploy the capital and to go and to back those businesses with the help of programs like the one that Ladé described earlier.
Thanks, Angela. I would just ask another question about evaluating the impacts of the investments. This crisis of COVID-19 crisis highlights the weaknesses of many countries around the world and also in Africa. With the inappropriate health systems, the increased poverty, the gender inequality, to name just a few of them. Is today's situation not a wake-up call for investments, just to try to identify projects with great sustainable impacts? Does that affect you as investors?
Absolutely. I think the sustainability angle is one that in times of crisis, people end up thinking about more acutely, but that has started already a while ago, that a bunch of investors are a lot more focused on these issues. And that's for a simple reason. We cannot keep on running our planet like it's, a business almost going into liquidation. We're depleting the resources, so we're creating more and more inequality, and all these things are getting worse and worse on many basic, and business will not have a license to operate in the medium term if it's not doing the right thing for society, for the stakeholders, for people around. So it's not even just a sort of thing where we're saying, oh, I want to do good. No, if you want to keep your license to operate as a business, if you want to be recognized by your consumers, by your employees as being on the right side of history, if you want to be as well supported by unfolding regulatory environments and making sure that you're on the right side in mitigating your risk in the front of regulatory changes, you have to embrace that now. You have to embrace that yesterday. And that's probably a wake-up call, what's going on with this crisis, that will hopefully get more people going into that. But I think that with or without COVID, this is something that there's no going back, and it's an exponential curve from then on.
Do you agree, Guido? Will sustainable impacts become a very important criteria for the investment project, for investing in projects?
I think, there certainly has been momentum around impact investment. First starting with SDG investment and ESG elements being added to the mix. And I think lately impact investment that has really gained a lot of momentum. So I think this crisis will only accelerate that. I agree with Angela that that's the case. It will just make the agenda, the impact agenda, more relevant in these circumstances. Vital already was an impact investor since 2011. So it's in our DNA to look at impact very explicitly. So for us, it's a very important investment consideration. We only invest in things that we think really benefit local communities, as well as looking at as ESG risks in our investments. And so we've decided that even in a situation like COVID-19, we are not going to compromise on that. So when we look at businesses that are in dire need, we are going to still prioritize capital to those businesses where we get most impact bang for our buck, so to speak. And I think a lot of the international community will look at that as well. There's a lot of initiatives, there's a lot of capital being made available, but the demands are also massive. And I think for companies to really articulate well what their role is beyond generating a financial return to their shareholders. For companies to really articulate, what is their real purpose? How do they serve local communities? How do they treat their employees? Yes, how do they treat the environment? I think companies that are paying attention to these matters and are also able to communicate this convincingly and genuinely to financiers, whether it's loan providers or equity investors alike, I think they'll get priority. So yeah, it's very important in these times as well that the company, as Ladé said, that companies think about what their real purpose is. And I think a lot of local entrepreneurs don't probably think that way about their business. They'll probably just are in firefighting mode and just try to keep their business afloat and to grow it. But to ask, what is my real purpose? How many people do I really touch, whether it's suppliers, whether it's my own employees, whether it's my customers, whether it's the government through payment of taxes. I think this is all important to consider, to have a more holistic view on the business. And I think that will make it easier to raise capital that is looking explicitly for that type of returns as well.
Tito, same question to you about the sustainable impacts of the projects you can invest in.
So we how we think about it with impact, at least, is it does have to kind of come from a big brother point of view, in the sense that yes, we already have ESG cooked into our thesis, but I think a lot of companies need to do the work to document. And a lot of investors need to do the work to, make companies do ESG reporting. I think even on the investor side, so general partners need the limited partners to put, ESG into LPAs. So limited partnership agreements have to have ESG in it. I think everybody has to do their part. So you even have governments having to, have some sustainable impact in how they give businesses licenses as well. I think everybody has to do their part with impact. We do ours. But the thing is, you can get a bit you can get far away from impact if you don't document. And I think documenting is probably the first step in putting checks in place, so you're always putting some impact back. We're proud we've made with our portfolio, but we do see people and we're like, look, if you don't document this stuff, you're gonna forget, or somebody's gonna go over the line one day. And so I think documenting is a core part of it, and the big brother approach of everybody doing their part is also a really core part of doing sustainable impact.
Thanks, Tito. Now we are going to focus on the second big question of our discussion, which is the investment process. Usually it takes a long time between the moment you ask for fundings and the moment you actually have the money on your bank account. But the crisis is the world is facing is now, and many investors are wondering how they can have access to the money to face the actual crisis. So you as investors cannot have access to field information. You can process due diligences as you usually do. So how you as investors will be able to undertake the necessary due diligence while you cannot travel to see the potential projects? How does the situation affect the way you do the process normally? Ladé, maybe first?
Sure, and I'll just make a, sort of an ending comment on the previous question, because I fully agree with what the other panelists have said. And I think one of the challenges is that with a lot of SMEs in Africa, they don't actually have the capacity or the skills to be able to document or even to understand how to measure impact. And you always have the tension between correlation and cause. So, the fact that there are frameworks that have been developed, if you look at various industry associations even how you incorporate ESG guidelines into your investment thesis, but also for the portfolio companies. If you look at the DFIs, they have a series of frameworks that they utilize. So instead of reinventing the wheel, I think this is again where the technical assistance can be utilized, where funding is made available to help these companies learn how to apply them specifically to their own businesses. And it's always important to do both the ex ante and the ex post assessment. So at the start, you know, what is it that this business or this project is looking to create in terms of impact? What are the outputs and outcomes? And then after the fact, have you actually hit these targets? I think it's also important to take that into consideration. Now, with regards to reducing the lead time to actually getting to financial close or getting, you know, money out the door, some of the things that we have seen as facilitators of investments and blended finance more specifically, we've seen cases where investors are now operating through partnerships where they are sharing due diligence information. They're also relying on their local partners to be able to actually go out and do some of that DD that they can't, and because they're no longer able to travel and, you know, social distancing. So I think that we already have some of these mechanisms in place, and maybe we do need to share more due diligence information, and also take advantage of the DFIs and the donor agencies, because they all have local presence, and they are vested in helping these companies to survive because of the jobs, you know, and the impact that they are creating at the grassroots levels, whether it's income or job creation, you know, and so on and so forth. So I think even tapping into some of the existing partnerships that they have on ground would be beneficial to investors more broadly.
Thanks, Ladé. Angela, the same question concerning the current conditions for the companies to have access to the investments. Are there any changes in terms of requirements from potential investors due to the crisis today?
I wouldn't say it's like fundamental changes, in the sense that we have a very thorough, you know, investment process in terms of making decision to buy companies or to invest in developing certain business areas, and I think that hasn't changed. You keep the same discipline, and you make sure that from the start on, like, you know, the management quality has always been one of our key criteria. Management quality means what? Means looking at the management first vision, philosophy, sustainability understanding, which is for us something very, very important, like how they look into like how much they're adding value to the ecosystem in which they're operating. Number two, it's like looking at their discipline, the way they're looking at their, you know, budget or their forecast, capital allocation, like are they smart in their capital allocation, their resource allocation. Third is looking at the team in general, the way the team are built, the way they're incentivized, the way they are aligned all together and with their investors. And fourth is the level as a team, as a management quality, the level of governance, transparency in their communication, you know, and really, I would say ethical professionalism in the way they're dealing with running their business, and you know, and in particular, like being really straightforward of dedicating all their time to what they're doing, being focused and being forthcoming. So those were always like criteria that are very important for us to invest, even more so than the actual pure business model, which can change over time, that can pivot, that can evolve. The team, those criteria for us are essential to feel comfortable being long-term partners with any entrepreneurs or any business. And I think that hasn't changed, and it's even more important in that time of crisis. We need to even more be sure that the guys that you're backing are disciplined, reliable, transparent, forthcoming, communicative, and visionary more than any other time. Like here, it's a question of life or death. Either you are, or you're gonna really struggle. So I think it's just like those things that we're looking at and we're more emphasized in the current environments.
Guido, some question concerning the approval process and the whole process that you usually take before investing. Due to the current situation, what did change, and will maybe the approval process, or the disbursement will be simplified?
Yeah, for sure. I mean, we looked at the impact, and we thought that one of the biggest impacts on companies that were profitable and growing before is a liquidity crisis, right? Suddenly, sales have dropped, or you have receivables, or whatever the case may be, creates a very real short-term need that needs to be addressed. And I think that's why we created this facility to provide debt. I hear the suggestions around pursuing equity and concessional finance and grants, which I think is always good to look out for if you look for more long-term finance. I think if you're faced with a very short-term need, then you probably want to explore debt, and of course at the most favorable terms. And so, yeah, we understand that businesses need monies tomorrow, and that we can't go through a month-long or due diligence process that takes month and month, and talk about all sorts of conditions and bells and whistles that sometimes come with more complicated financial products. So what we offer is something very simple, straightforward, a loan, with a repayment which makes sense for that particular business. If there's no collateral, we can look at that in a flexible way. For us, it's just to make sure that companies that are really fundamentally strong have a good track record in their local communities, both from a financial point of view, from a sort of repayment point of view with their existing bankers, that those companies can continue doing what they're good at. And so, yeah, we understand that we can't fly, to all these countries to do a due diligence. We have to rely on how the companies present themselves. We also use our local networks. So companies that are well plugged into their local communities, we will do extensive referencing. And then, yeah, I guess like we do now, Zoom calls with management, with customers, suppliers, and we really have a dedicated team. So again, we try to do everything within 45 days to get money to these companies. So yeah, we really have simplified the process and relaxed a lot of the criteria.
What for you, Tito? Do you also had changes in the process? Has it been simplified or shortened to face this situation?
So at the firm, so the process and the amount of diligence that needs, because I have fiduciary obligations, right? I have, a remit to my limited partners. So I can't speed up the process and give up diligence, right? So I have to find a way to shorten the time, because I know there's cash flow constraints. So you can do this easily by, instead of doing an equity round, you do a convertible note round, because then you lose, shareholders agreements and all the signing. You speed up the process by doing that a little bit. Also, obviously, I've had to put in, a couple more hours than usual, and everyone at the firm has, just to speed up processes that, would usually take 3 months. You have to drop it down to, a month and a half. So people have to do a few more hours. So people, would say, during COVID, I don't have that much work. Actually, I have twice the amount of work now. We've managed to close 3 deals. So one in Nairobi, we're close to closing one in Egypt, and one here in Nigeria in the last month. So we're still very active in these times. So it's not affected diligence. Obviously you have to crunch harder numbers. So diligence becomes a bit harder because you can't really gauge a person. So at early stages in the company, you're really investing in people. To what Angela said, it's really about the team and the management. And without being able to see someone in person, it's really hard to diligence them. And leveraging networks. So for example, in Egypt, we had to leverage a lot of the people that we knew there and really get a sense of what these people were like. So there's a level of comfort you need to get to be sure you're giving back the trust that your limited partners are putting you to invest. But it's definitely a dicey one. with due diligence.
What piece of advice would you give to the project leaders who would actually seek for money in an emergency situation like the one we are facing now and the whole continent is facing now? What piece of advice would you give to them? Ladé?
I think I would reiterate some of the points I made earlier. One is to revisit your business model and to look for opportunities where you can pivot again or create entirely different revenue streams in response to the opportunities created by the pandemic. Secondly is I would look at the type of capital you're raising at this time, and just to be sure that you're not creating a future scenario where the company is basically unduly leveraged. I think it's very important for companies not to do that. And I think this is also the time for you to over-communicate, to ensure that you are being transparent, to ensure that you are reporting more so on things that you weren't necessarily reporting before, but just basically continue to strengthen investor confidence at a difficult time such as this, so that you are able to access the emergency liquidity, but even going forward, that your company is in a much better financial position, and ultimately, hopefully you recover from the pandemic and can actually raise additional investment to continue to grow as a business.
Angela, same question. What piece of advice would you give to the investors that look for money today?
So I think there's a sequence of action that they have to look into in a certain order. First, the first money that you should think of raising is the money that you can actually more think of saving. Because obviously, if you're making like a saving of, let's say, whatever, like even $50,000 a quarter, that's like you raise almost $250,000 in a year time. And just like this money saving is very important, and don't do it just from a cost cutting. Okay, I can cut a little bit of cost here, a little cost base there. Like, McKinsey called it in one of these latest reports, like the zero-based thinking. Like, look from a clean sheet. Go back to a clean sheet. Like, there's a saying that says never let a crisis unused. Like, don't take the bad out of a crisis. Use that crisis to go back to a clean sheet. What are the core services and products that you're looking to supply, and the core markets that you're looking to serve? Is there a way to do it in a more efficient way, in a better way, and in removing some of the superfluous costs that you had on your plate just because they accumulated out of legacy, out of time? So first, go back to your core business with a white piece of paper and rethink it, and that's already going to make you raise money without diluting yourself, right? The second part, and going back to what Ladé said as well, I think there's a lot of schemes out there that are quite interesting, that are here to support businesses, and any entrepreneurs that doesn't do like the kind of like, almost like desk work, because this is just at this point like desk work, to leverage all of that is just like, is not doing like something that they should be doing at this time. Those schemes are there to support them, and that's quite important. And then like the next thing I would look at, if really all of that is not enough, and if you need more money after all of that, which is already quite a lot of money that I think you can unlock here, if you need still more money, the first step is to go back to your current investors, because obviously they know you, they know your track record, they know what you're doing, they don't need like a due diligence on the ground, they don't need all that. So you go back to your current investors and you do which one are able to deploy a little bit more capital. And then as a last resort, you go to the market, because going to the market now, it's time consuming, it's difficult, you have to build a reputation from scratch in an environment that is difficult, where everybody's struggling. I mean, they're going to lose a lot of time, it's going to be cumbersome, it's going to be complicated. I would really do it as a last resort.
Thanks, Angela. Guido, I have also another question, because in your previous answer, you said that businesses need money right now, but what about midterm and long term? Should it be combined with equity investment?
I think, equity investment is a very specific type of investment, and we've been doing that as Vital as well. Yes, that certainly has a much longer term perspective, and it will have implications on how your business is run. It's essentially a change of in ownership. So I think that's also something that's people can consider, but it takes time. I don't think in this crisis you should not suddenly decide to sell half of your business just to get money. I think that needs a lot of thought. So that was really the point I was trying to make around, if you have indeed a short-term cash problem, I very much agree with Angela. First look at your internal cash flow and see where cash can be saved in a responsible and sort of a sustainable way. Yes, talking to your bankers and see in your current shareholders, investors, to see whether they have additional capacity to support you. And I would add, talk to your network. I think businesses that are really part of an ecosystem that have good relations with accountants, with other players in the sectors. There's sector associations, business associations. A lot of those ecosystem players know what's out there in terms of funding schemes. And I guess as an entrepreneur, you do have to weed through all the noise. I think there's also quite a few schemes that are announced, but there's no money yet, or it's difficult to get to. So I think it's probably also important to not waste too much time pursuing things that either take too long or won't go anywhere. And I guess the only way to do that is really talk to fellow entrepreneurs, people in the sector, and find out what is the best fit, and really only pursue those that really where there is a good fit, not waste time on pursuing things that will just take forever to materialize or might not materialize at all.
Thanks, Tito. Same question for the advice you would give to the people seeking for investors right now.
So I think, first of all, it's really important to remember that the best companies are built in these times. So I would say, honestly, investments will still happen because we're still active, and I think a lot of people will still be active. And it's really just to understand that it's conviction that will be redefined, so investor conviction. So I think just resounding everybody's points about taking your business apart, really understanding things, building a lean machine with good unit economics is really important, because that's really attractive for investors right now. And I think also, trying to reshape your product for a post-COVID world, be it temporary or long-term, is really important. And obviously, doing the research on financing types and routes, and also doing the research on term sheets and what people will come at you with in these times. So different kind of deals you're going to be getting, and the different kind of investors, because I think when these things happen, the really nice, smiley investor becomes a shark because he sees opportunities. So it's really important to remember that and really know your terms and conditions, right? And I think something that's important, and it might not be very close to raising money per se, but it's also like your mental health, because being a founder is really stressful. You add COVID on top of that, and it's crazy, right? So really taking care of yourself, because to raise money, you have to be mentally healthy. And I think a lot of people skip the mental health part of being a founder and the startup in this ecosystem, and it gets much worse now. So it's just being mentally healthy is really important to stand out as well. Yeah.
Thanks. I have a last question for all of you, and it will be your the last round table. Just maybe a more general question. Do you think that this crisis that we are all facing today, in every crisis there is an opportunity? So will this be the beginning of a shift in the business models, in the way of raising money? Maybe you will have more difficulties to convince investors to bring money to some areas or sectors in Africa. So do you think that this crisis will bring an opportunity or an occasion to build new business models? How will it be impacted in the mid and long term? Ladé, maybe to start with?
My short answer is absolutely. We've already seen that happening. I think the importance of technology across sectors has become even more heightened. You're seeing education technology, edutech, agri-tech, as Tito mentioned earlier, health tech. There's basically no sector that is not going to have to leverage technology moving forward. And we're already seeing very innovative business ideas coming out, especially from young people across the continent. So I think that there's definitely been a shift already. How we work is going to change. Talking about businesses being lean and more efficient, remote working, which obviously means that you have to have robust infrastructure to support that, allowing employees to be able to do that, but they also need access to electricity, internet. So the way that we work is going to shift. And I think ultimately businesses will have to demonstrate that they have adopted this new way of working when they are pitching to investors, because investors want to see, are you an efficient business? Have you adapted to the new reality within the pandemic and also post-pandemic, or are you still going back to business as usual? And if that's the case, maybe you're not as attractive as an investment proposition as somebody else who has. So I think certainly we've already started to see some of these shifts, and what I would expect is that we're going to see a deepening in the application of technology across different sectors, and new investment opportunities that did not exist before this pandemic, or maybe were not as pronounced, are certainly going to get a lot more visibility going forward.
Guido, same question.
Yeah, I think, when I speak to businesses, what strikes me is that, the impact is very different across sectors and countries, I guess, even. So, some businesses are hardly affected, some actually benefit from this, and some, are at the brink of collapse. So I think, those shocks are very unequally felt. And I guess businesses have to adjust also in very, asymmetric ways to that. So yes, but it's without question that some industries really have to change their models, and we as consumers and citizens all have to, change some of our behavioral practices. But I think maybe fundamentally, if I reflect on the topic of this conversation, getting access to finance, maybe that doesn't really change as much. I think as a business, it's still important. It was and still and continues to be important to invest in relationships with your local community, with your financiers, your investors, that when a crisis happens, and whether it's this or another crisis, and especially in Africa, there's no shortage of crises. It's important to be resilient, and I think it's important, or a source of that resilience sits in the relationship you've built with your suppliers, with your customers. So when something like this happens, you can speak to them and say, look, I need help. Can I get better credit terms, or can I, whatever the case may be, even your employees, I can't pay you fully. Can we agree on something that makes sense for all of us? So I don't think that fundamental really changes. But yes, I think some businesses certainly have to adjust the way they operate.
Thank you, Tito. Question also about, do you think that there will be a shift due to the crisis?
So I think there'll be a shift, globally. The world post-COVID, we don't really understand yet. So I think a lot of the companies that will be born from that will happen over the next 12 months. But I do feel like building out anti-fragility, so companies where chaos makes you more resilient, would be, the cornerstone of a lot of people's theses as they build out their businesses. I think that's really going to start getting important. And I think you will lose the blitz scalers. So raise money till we hit unicorn valuation, and then a lot of people will start earlier, focusing on building companies that may be profitable. We've seen a lot of problems with blitz scaling, and they're now more apparent because Mother Nature can turn a switch and change the world, clearly. But yeah, I think there'll be a shift in the kind of companies. So you have the companies that give you anti-fragility really blowing up. You have the companies that want to be anti-fragile, changing and innovating their products. And then you still have a few companies that are normal, everyday companies that just wait for their, industries to bounce back. Stuff like travel and hotels, those kind of verticals will bounce back. They have to bounce back. And it's just how those companies then build out their products to deal with the post-COVID hotel industry or the post-COVID travel industry. That's important. And I know there'll be shifts. For some people, great. For some people, bad. And some companies become completely, out of whack and they can't work anymore. But we're really excited with the kind of companies that will come out of this. It would be really exciting times.
Angela?
Yeah, I think basically what the crisis is doing is fast forwarding the future. Those trends were already underlying, growing slowly but surely. I mean, for fast forwarding the future on sustainability, fast forwarding the future on the future of education, future of work, the future of healthcare, digital remote point of care, healthcare for everything possible, doing it as well for education in a way that like everybody is becoming a homeschooler, which actually I've been personally already for the past couple of years, so that hasn't changed. So I think a lot of people are starting to embrace these trends of distributed, technology-enabled solutions. Now what we have to make sure is that this fast-forward future, which is happening without a lot of people being prepared for it, is not going to exaggerate inequalities, but will actually deal positively with inequalities. Because what we saw in our countries of operation throughout the continent, and we wrote an article, hopefully picked up by the government at the time, just like months ago, is okay, we got all our staff to work from home and their kids to be homeschooled, but guess what? They don't have internet. Guess what? They don't have 2 or 3 computers so that their many kids can work or the parents can work. Education is hard. Put on TV stuff that are educational, at least hopefully some of them have TV, not all of them, obviously. So how do we make sure that technology is being deployed for everyone at scale in a way that is inclusive? And then those trends will actually create a lot of positive outcomes. We need to make sure that the future is better distributed, digital, but that it leaves no one behind.
Thanks a lot to all of you for this very interesting discussion. Ladé, thank you. Angela, Tito, Guido, thank you very much. And thank you all for following this discussion, and hope to see you very soon. And in the meanwhile, take good care of yourself wherever you are.